Hi, my name is Marin Katusa. Over the last 20 years, I've visited over 100 countries, over 500 projects, become one of the largest financiers in the resource sector, and wrote a New York Times best-selling book. But what I'm going to share to you is a very original concept that is going to shock a lot of the mining executives. In fact, it's going to make them very angry, and it's going to infuriate them. But my portfolio and your portfolio does not care if management teams like you or not. It's about being prepared when the opportunity arises. What I'm going to share with you today is going to have major geopolitical implications on the coming war on gold. Now, it's not the type of concept you think is going to happen. The war on gold has already started, and yet nobody, no media, no government, nor the companies are actually talking about it. After today, I hope you use this information that I have shared, this factual-based data that is happening in real time, to empower yourself and your portfolio to profit from it financially. To understand the blueprint of what is going on geopolitically and the coming war on gold, all you have to do is focus on the swap lines. The swap lines are a big tell on what is happening globally. Let me first explain what a swap line is. The swap line is set up by the US Fed, and currently, as you can see on the screen, there are 15 nations that have been approved for swap lines. This is just the beginning. What a swap line essentially means is the Fed, the government, the US government has pre-approved the nations as allies who've accepted the terms and conditions to be able to draw down money. For example, the Bank of Japan over the last 30 days has drawn down over $200 billion on their swap line. Now, the reason they're doing that is they need access to US dollars. There's 15 nations. This is just starting. And what this really means is the US government has approved those nations essentially as a real ally. Now, I call this positive swap line nations. The negative swap line nations are countries that do not have existing swap lines. And for example, a country like China is not going to get a swap line. Russia is not going to get a swap line. Iran, with the current regime, will not get a swap line. Turkey, maybe in a few years, if Erdogan accepts the terms and conditions, may get a swap line, but right now they do not have a swap line. Those are nations I call negative swap lines. Those nations are going to be accelerating what I call the war on gold. Now, what do I mean by that? You see, if you have a producing gold mine or any asset in a positive swap line nation, they are not going to want to screw around with companies that are backed by Uncle Sam, the American government, the American military. Yes, taxes will increase across the board. That is the only thing all politicians in all countries have effectively executed throughout time. But what I mean by the war on gold is increasing royalties, increasing taxes, increasing government take of ownership, and in some situations, there's going to be outright nationalization of foreign-owned mining assets. On top of that, mining companies and negative swap lines are going to have FX restrictions, meaning when you produce the gold, you're not allowed to be able to sell it to the international markets. In the negative swap lines over the next 3 to 5 years, I see a situation where the producers, take any one of these foreign-owned mining companies, are forced to sell to the government at a fixed rate. Then it's in their local currency at the government fixed rate, not the real international rate, the government rate, which is unrealistic. Then to convert that money back to US dollars to send back to their investors, they're going to have to convert at the government rate again. So the government of these negative swap lines, in the best case scenario, are going to be really aggressive on these FX controls and taxes to get that money out. So moving forward, I think you really have to pay attention to positive swap line nations and negative swap line nations. Positive swap line nations, the 15 countries that have pre-existing swap lines in the last 30 days have drawn down almost $500 billion in swap lines. At this rate, by summer, the swap line nations, just the 15 countries that I've shown here, will have drawn down over $1 trillion if they continue at the same rate. And that's assuming no further swap line nations are added. There's going to be more swap line nations added to this. And it's really, think of it as a G2 world. Nations that are with America and the nations that don't have swap lines that are influenced by the emerging market superpowers such as China and Russia. So what does all this mean? Swap lines, positive swap lines, negative swap lines. To really understand what this all means and the implications, we got to go back to the US dollar, which is the reserve currency of the world. Now, when you take all of the central banks around the world, the US dollar makes up just a little over 60% of the foreign reserves of all the central banks in the world. The next highest one is the euro at about 20%. Then it's the Japanese yen. But really what happened was at the global financial crisis, so much QE and stimulus got into the market. And from the period of 2000 to 2008 were the golden years of globalization. The emerging market nations that were commodity rich took massive debt to build these infrastructure projects and mining operations and oil programs in US dollars. And it takes many years to build these projects to produce commodities in US dollar. And China took a lot of debt to build manufacturing hub of the world to sell to the US. Now, the global financial crisis was a big wake-up moment for the emerging market central bankers. If you look at the next chart that I'm showing here, from 2000 to 2008, the central banks around the world were actually net sellers of gold. Meaning, if you take all the central banks combined, they were selling more gold into the market than they were buying. But after the global financial crisis starting in 2009, the emerging markets led by Russia and China, you look at Turkey, all of the emerging markets woke up that they are a potential victim of the power of the US because of the US dollar dominance. So they became net buyers of gold for their Federal Reserve. Because of the global financial crisis, all this QE, all this debt, we saw negative interest rates around the world happen, and that's actually deflationary. As these commodity prices are going down, the emerging markets, their currencies are getting devalued relative to the US dollar and gold in these emerging market nations, and even in the euro and the yen, the Canadian dollar, the Aussie dollar. They're all getting devalued to the US dollar and gold. In China, which was the manufacturing hub of the world, was playing both the reserves and trying to catch up buying gold. But then this COVID black swan event happened, which really accelerated this gigantic bubble of debt that we were in. And again, it accelerated deflationary measures. That's how we've seen a big drop in coal prices, copper prices, oil prices, the base metals across the board. And look, this commodity index right here shows you that we're at the lowest price ever during the tracking of this commodity index by Bloomberg, shows that commodities have never been cheaper. But you see it's relative to the US dollar. So going back to my concept on the war of gold, the emerging markets can protect themselves via military, which will take a lot of time to catch up to the US, but also as a defense to the US dollar is to buy gold as a percentage of their foreign reserve currencies. So the current situation, this chart that I'm showing here right now, shows the percentage that gold makes in the foreign reserves. If you look at a country like France or Italy, over 50% is gold. Look at that bottom line, that red line. That's where China is on their relevance of gold to their foreign reserves. Now, Russia is where China wants to get to over the next decade. See, during the global financial crisis, one weakness that President Putin had was his gold percentage to his foreign reserves. He went from under 4% to almost 20% in a decade. The Chinese right now, if you look at that route, are less than 3%. They're at 2.9%. So if China wants to just catch up to even match the US, which is impossible, they would have to buy 100% of all the gold produced in the world for the next 15 years. That's not realistic. That's not going to happen. But the Chinese recognize that they have to buy more gold and have been one of the larger buyers of gold every year. In fact, a lot of people don't know that China is actually the largest producer of gold in the world of all the nations. and not a single ounce of gold produced in China gets sold outside of China. Now, I'm sure there's some smuggling in here and there, but the point means that most of it goes back to the government. If you look at the third largest producer of gold in the world, we're the US. They sell a significant amount of their gold into the international markets. Now, the US is still the largest gold owner on a percentage of their foreign reserves, but that makes sense because the US dollar is essentially the reserve currency of the world. So relative to the other currencies, the government of the US is saying we'd rather own gold than the currencies of the other world. That is a super bullish argument. From this next chart, you can see what President Putin mandated, the quarterly purchases of gold for Russia's bullion, for their Federal Reserve. And you can see that they got up to just under 20% of their foreign reserves in gold. China would have to buy over 128 million ounces of gold just to catch up to the ratio of where the Russians are at. That's over 1 year of all the gold produced in the world. Again, unrealistic. So they've got a long-term strategy here to diversify away from the foreign reserves and to buy more gold. The Chinese government has come out and mandated that, and they're investing significantly. Now, this brings me back to my war on gold. Countries with negative swap lines are influenced more by non-US interests and thus are going to be leaning towards policies of the Russians and Chinese that go against the best interest of the American government. Hence why the US won't be giving them a swap line. And the first thing that these negative swap line nations who are in need of a US dollar are going to do is tap into the existing producing gold mines, because that essentially is real money. And by increasing the taxes on that and even increasing their ownership, and in some situations, nationalizing those assets is a way to come up with real money. And the local economy, the local citizens will claim that it's for environmental purposes, that they've kicked out these foreign companies. That's false. The war on gold is going to manipulate all sorts of media, but they're coming after the gold of foreign interests in negative swap line nations. If you look at this chart, you see the emerging market superpower nations have been aggressively buying gold over the last 3 years. This will continue. We've just started this massive war on gold. Of the 75 million ounces of gold produced in the top 10 countries last year, half of that gold is in negative swap line nations. But who created that gold? Who funded and produced that? They are companies that are funded by Americans that are listed on the US stock exchange and the Canadian stock exchanges, also the Australian stock exchange. It's positive swap line nation companies that are producing the majority of the gold in the negative swap line nations. That is the beginning of the war on gold, as these negative swap line nations are going to start increasing their government take, the taxes, the royalties, and the FX disadvantage that is going to apply in these negative swap line nations. This risk is very real. Expect higher royalties, expect higher taxes, expect a creeping take back of ownership of the mine from the government. Again, I can't emphasize enough, you're going to see nationalization of these foreign-owned gold mines in these negative swap line nations happen. In addition, they're going to add FX controls on these companies, where it's going to be harder to get their US dollars out, and they're going to be taxing it on the conversion. You're also going to be selling the gold to the governments of these negative swap line nations in their local currency. So the price of gold that is the international market, you won't get that in the negative swap lines. Now, I understand this is going to be very difficult for a lot of people to understand. And for many mining executives, they don't want this to happen. It doesn't matter what you want. The reality is the world's geopolitics is changing so fast, and the virus has accelerated this G2 world, where, again, there's a line being drawn between positive swap line nations and negative swap line nations. This next chart that I'm going to show has never been shown before. It's never been created. You've never seen this before, because I created this metric. What I've done is I've taken the 10 largest gold producers in the world. These are mining companies, and I've taken their production and broken it down between operating cash flowing gold mines in positive swap line nations, which is in green, and negative swap line nations, which is in red, right? Green good, red bad for us investors. And I want to highlight a couple of things here. First of all, when you look at Polyus, that's a Russian-owned company. So it makes sense that it's all Russian assets. They don't really care for your money as an investor. Navoy also is an Uzbek company, which is a former Soviet Union state. Again, it's a negative swap line nation. It's not the interest. But let's take a company like Barrick. It's a top 2 gold producer in the world. And yet you can see that over 50% of its gold production is in negative swap line nations. All of the pension funds that are investing in this big multi-billion-dollar company run by Mark Bristow, who's a mining executive, very smart man. I have nothing but respect for the man, but he's well aware of the risks that he has on these mines. And something you should be asking yourself is, why are companies that have exposure to negative swap lines getting the same discount rates on financial modeling as companies in positive swap line? You're going to see that this is all going to change over the next 5 to 10 years. I like being ahead of the curve, and that's how you become successful in such a cyclical and volatile industry as the resource sector. Now, you want to look at a company like Agnico Eagle. They have 100% of their production in positive swap line countries. That's a good thing. They're not going to have those risks. Now, I'm not recommending any one of these companies. Actually, I don't own any single one of these top 10 company producers. There's one that I am trying to buy, and I have a specific price point for it, but I'm waiting for certain situation to happen. And I'll get into that later. Mining is a very complex business. Everything that can go wrong probably goes wrong. But after you do get it right and you do build this mine, you don't need that extra layer of political risk. And that's what this webinar is all about. I'm trying to expose to people where I think the geopolitics is moving forward. Remember, after traveling to over 100 countries and writing a book about it, I've learned a thing or two in the past. And the last thing you want is to add another layer of risk on top of an already risky industry. But you see, in the resource sector, specifically the precious metal sector, gold and silver, the royalty companies have been known as the lowest risk way to play it. And for good reason. They don't take any of the execution risk. They don't take any of the permitting or development risk, cost overrun risk, the operational risk. What a streaming and mining company essentially does is they go to a mining company, and because they trade usually at a premium to their net asset value, and mining companies trade at a discount, there's an arbitrage opportunity that they can finance and essentially loan a mining company for a positive future value. So for example, they go to a company like Barrick or Newmont or any one of the top 10 mines, and they structure a stream or a royalty at a fixed price, significantly below the spot price for a set amount of gold for the life of mine and that project. So they get all that upside. Because of that factor, they don't have the big depreciation of mining trucks. They don't have to worry about the labor of the mine, which is a big cost of the mine. And generally speaking, in the mining world, it's the most profitable per person, per revenue. But when I applied this metric that I created onto the streaming world, these well-accepted, low-risk companies, you see that actually they're not that low risk. So what I've done here is I've applied the revenue from streams and royalties of the top 5 streaming companies in the world that are publicly traded into positive swap line nations and negative swap line nations. Now, let's take Franco-Nevada. Great company. Essentially pioneered the model. They trade at over 3 times NAV. I have no short position on the company. I have no issues with Pierre Lassonde and his management team. I think the man is a legend. But what I'm trying to do here is to put into perspective, using facts that no one's ever done before. Over 55% of their revenue comes from negative swap line nations. What can you expect? Well, you can expect the government wanting a piece of each stream. This is what's going to happen in the war on gold. You can include silver in that too. In fact, you can include every commodity on the planet. This is a game changer that nobody is talking about. And if you look at the financials, it has already started in certain parts of the world. Negative swap line nations have already started the war on gold of foreign-owned operating assets in negative swap line nations. Now, where are we in the gold sector? We are in the very early days of this war on gold. In fact, nobody's ever talked about this before. If you look at this next chart, here you can see that we are in the very, very early days of this gold bull market. In fact, gold is in a bull market in every currency except the US dollar. Now it's risen up in the US dollar, but it's not officially yet traded above 1750 for over 14 days. It looks like it will, and it will eventually, and we are very early days, which means countries like China, Russia, they're looking to increase their exposure in negative swap line nations. So I've already mentioned that 2/3 of the top 10 producing countries in the world for gold are negative swap line nations. Here's a stat that's going to scare you even more, and it should. And all the mining executives are going to be rattled by this fact too. Every year for the last decade, they're finding less and less gold every year. And yet they've been spending over $4 billion annually looking for the gold. So are the geologists worse? No. It's harder and harder to find economic deposits, and it's harder to find gold, period. That is a very bullish statement for gold. But the problem is much of this gold is in negative swap line nations. And that gold in the negative swap line nations is going to be exposed to the war on gold. Now, there's an old saying I love that, God may have created gold, but the devil went and spread it around the world. Unfortunately, some of the big, big deposits are in negative swap line nations. This next chart shows you the gold majors, their production versus the cost. You see the significant increase in costs have over doubled over the last 15 years. And yet the production from the majors is going lower and lower. And I've already shown you that the gold majors, the North American owned, the investors like you and me and the pension funds and all the big fund managers that own these publicly traded companies, a company that has over 50% of exposure of their production in negative swap line nation is going to have to rethink their business plan. While the rest of the world currently is focusing on ESG, environmental, social, and governance, they're forgetting the most important aspect, which is political risk. This war on gold is significant. I'm not trying to downplay the ESG importance in mining. In fact, most of the Canadian and American mining companies are leaders in ESG when you compare it to some of the foreign-owned mining companies. I think ESG is very important. But nobody is focusing on the political risks on the current negative swap line nations. You see that the gold majors, the companies that produce over 1 million ounces of gold or more a year, have increased their cost by over 100% in the last decade. And yet the black graph there, the black bar graphs show you that the production is decreasing. This next chart I'm showing essentially shows how world-class tier 1 and tier 2 deposits are becoming rarer and rarer. The trend is your friend. A tier 1 mining gold asset is a deposit that has at least 5 million ounces or more that can produce 500,000 ounces a year or more for at least 10 years. A tier 2 deposit is a deposit that has at least 2 million ounces or more a year and can produce at least 200,000 or more ounces a year for at least 10 years. And they're not finding any more new grassroots discoveries. Over the last 30 years, you can see that we're not finding any more gold anywhere near the rate, but we're spending over $4 billion a year for the last decade, and we're not coming up with the results. And because of the time lag moving forward, the time to finance, permit, and build these big projects, the gold we're producing today was found 15, 20 years ago. But we're not finding any gold today. So what are we going to be producing in 15 to 20 years out? And the biggest question is these emerging market superpowers who are looking to increase their gold reserve ratios to their foreign reserves, where are they going to find the gold? Hence, they're going to have a war on gold. In the oil patch, they have something called RLIs, the Reserve Life Index, which shows if their current deposits keep producing, how many years of life at the current rate of production do they have. You can see that if you take that same metric and apply it to the major gold producers who produce over 1 million ounces or more a year of gold, they've dropped over 40% on their average RLI over the last decade. Again, that is a very alarming rate. They're not finding new gold, but they're spending money to find gold. Hence, it's coming to an inflection point again, which is very bullish for gold. But again, I cannot emphasize enough. As gold becomes rarer and rarer, you want to be exposed to positive swap lines so you don't have that extra risk of the negative swap line nation. So to summarize, I've tried to explain an original concept that is getting essentially zero attention in the market. While the investing world, the governments, and the mining companies are talking about ESG, which is environmental, social, and governance practices, which is very important, everybody is overlooking the current issue of the war on gold, which is the political risk of the negative swap line nations who are at risk of the US dollar shortfalls in their negative swap line nations, and the increasing taxes, royalties, and increasing ownership, and in some cases, nationalization of foreign-owned assets by these publicly traded mining companies in negative swap line nations. Now, how do I counter this? In the first 10 years of my career, I was lucky to be mentored by some of the best in the business. I made lots of mistakes. I still do. Nobody's perfect. But you see, I become one of the major financiers and investors in the sector by putting my own money, my own skin in the game. The best way to play the resource sector is to either play via private placements or to be an alligator investor, which I coined this phrase of being patient when everyone is greedy, and when everyone is nervous and panicking, that's when we become financial apex predators. Now, I've done it many times for my subscribers. So I'm going to break my two strategies apart. Private placements, which I call PPs, in my opinion, is one of the best ways to invest and speculate in the gold and mining sector. What is a private placement? A private placement is when a company needs to raise money to build a mine or advance exploration or development, and they go to people like a major broker, a financing firm, a bank, fund manager, and they set terms where you want to raise $100 million. Let's say the stock is at $1, and you also get something called a warrant. Now, I created something called the Katusa warrant, as phrased by my good friend Rick Rule, which he calls the Katusa warrant, which is a full 5-year listed tradable warrant. Over half of the warrants on the market that trade were created by me on that. So how do you get into that? Well, let me give you some real life examples. In 2016, when I did the Northern Dynasty, we put $43 million into a financing that came with a share and a warrant. But remember, the warrants that I do, we list them onto the stock exchange. So it was a New York Stock Exchange listed company and a Toronto Stock Exchange company. So it had its own CUSIPs. So with the financing, you get a share, which at that one was 45 cents a share, and you get a full 5-year warrant that is exercised. It's an option essentially that had its own trading symbol, and that was exercised at 65 cents. Within 12 months, that share went from 45 cents to over $4. And ironically, that warrant also went from, zero value because you didn't pay for it, all the way to over $4 a share it traded. So that 45-cent cost base traded a combined value of over $8. So you had over $7.50 profit on 45 cents invested. And that was on the Pebble deposit, which is the world's largest undeveloped gold copper porphyry deposit in Alaska. I went and visited it myself. In fact, I went up there with the world's greatest living geologist, a guy named David Lowell, who has a mining school named after him. And that's part of my network. I'm not the smartest guy in the room, but what I do know is how to go and find the smartest people in their sector. I have guys like David Lowell, Roman Schlenka, Jim O'Rourke, guys who have built multiple mines. One thing you learn about Pareto's law is they're not just lucky. There's a pattern to success, and stick and learn from the best in the business. I've done more private placements, in fact, than some of the biggest brokerage firms combined in the industry over the last 5 years. I've raised over $3 billion doing that. But for my subscribers, I'm always the lead order. I take 0 commissions from this, and everyone gets in at the same time and price as me. And I send out an alert that they get out. They can sell before I sell. That's just my style. Now, private placements are not for everybody. If you're a family office or an accredited person, you should definitely be paying attention to private placements. The warrant is a huge advantage. But being an alligator investor takes patience, and it's very, very hard to do. You have to be disciplined. You do your homework. And when it's time to be a predator, a financial apex predator, you go out there and you can't hesitate. Over the last 60 days, we've had incredible gains on some very well-known stocks. When funds were blowing up, we bought big allocations of dividend-paying stocks by being an alligator. That's also a strategy I use. And what I do is I do all the analysis, the site visits, the videos, and you get to see what I'm doing in live time through a video like this, interviewing these management teams and CEOs. And I say, this is the price I'm willing to pay for the stock. I use a tranche system where you never buy your 100% of your allocation at one time. I buy in 25% tranches at a specific price. And I detail that all out. We've had some incredible gains by following this strategy. Like I showed earlier, gold is still in its early days. We are nowhere near at the top of the bubble, but we are also at the beginning of the war on gold. And by not understanding the difference between a positive swap line nation and a negative swap line nation, your investments could be at considerable risk. Prepare yourself, educate yourself to benefit and not lose money. Warren Buffett said it the best. The number one rule of investing is don't lose money. The second number two rule, don't forget number one. Now, I hope I've shared a unique perspective. I also hope the mining executives start looking at political risk in a different way. The mining analysts and the investment bankers are not going to like this because they want to sell product. But the reality is in the next 5 years, we're going to see negative swap line nations be discounted at a different rate than positive swap line nations. Now, mining is risky across the board. You don't need any extra risk. Fortune favors the bold, and hopefully what I've shared with you has educated you enough to benefit your family's portfolio. Stay safe and healthy in these volatile times.